Hello and welcome to HowStreet.com video. I'm Stirling Faux and it's a great pleasure to welcome Jack Crooks from Black Swan Capital in South Florida to Vancouver, Canada for a chat. Jack, good to see you.
Thanks for having me, Stirling.
Your president the other day expressed considerable concern about the Chinese currency situation. Stopped short of accusing them of any manipulation overtly, but the administration's pretty cranked up about this. Should they be?
They should. China's currency has really been manipulated in a very, very big way. If you consider the size of the Chinese economy and the growth, even since 2000, they've been booming. Most estimates are the Chinese currency is undervalued 30 to 50%. Some people say 70% undervalued. It gives them a distinct advantage, not only on the export side to have such a low currency, but it also gives them an advantage on the capital raising side. And I think one of the major concerns is not only this whole idea of trade, but capital being sucked out of the U.S. and some of the developed nations into China because their labor is so cheap on a relative basis because of the currencies. Currencies are supposed to balance these things globally, and China isn't playing the rebalancing game very well at all.
Well, now, if let's just follow that point a little bit because you've raised a good one here. If the United States dollar is as weak as we understand it to be, and I think it is, and China is as undervalued as you maintain it is, where's the danger for the U.S. dollar should China decide to be more realistic about the valuation of its currency?
I think there's less danger, and I think it's a benefit for the U.S. dollar if we see some type of change in the Chinese policy. Unfortunately, I don't think we're going to see it. But if we were to see that change, you would finally start to see some of the exports flowing both ways into China to a degree. At the moment, not only does China suppress their currency, but because China suppresses their currency and they compete with the entire Asian bloc, the entire Asian bloc sphere for exports to the West, the other Asian countries have suppressed their own currencies to compete with China. So if China were to let the wraps off, you would see revaluations really across the entire bloc, which would then start to level the playing field on exports in that standpoint. And I think it would be beneficial for the dollar in that you'd start to see some trade flow and capital flow coming back and forth and maybe rolling into the U.S. because ultimately capital formation will be good for the dollar.
But there is a kind of a catch-22 scenario with the dollar because of the global movement of currencies. Explain that if you could, please.
Sure. I mean, the catch-22 of the dollar is something that I think is in the consensus, and we don't think it really is part of it. And let me explain, I think, what you mean. Everybody has this mantra that a lower dollar is what drives exports, but the reality is, if you look around the world, some of the highest currency values around the world, Australia, Germany, for example, have massive exports. So the export decision is much more complex than just a low currency. So I think that's the problem. This mantra of a low currency driving exports to drive growth, I don't think is really the game we should be playing. I think ultimately the game should be driving capital flow into the U.S., increasing your manufacturing base, capital into the U.S. so you're not as dependent on other countries. And we're seeing that because we're seeing U.S. savers save in a very big way. We're seeing the pool of savings up to 6% of GDP. That ultimately will be beneficial for the dollar if our government lets that happen, because as our domestic pool savings rise, we don't have to rely on China and all these external funding sources. So there's several aspects to that catch-22.
Inflation. We see the U.S. Federal Reserve printing money literally faster than we can count it, or they can for that matter, and a lot of other central banks around the world doing precisely the same thing. So the concerns that spin out of all of that overproduction of paper currency is inflation. And yet you at Black Swan are more concerned and more focused on deflation. Why?
Well, a couple of reasons. Number one, the money that they're creating isn't getting to the private sector. There's been a negative, there's been no lending from non-bank lending at all hitting the real economy. U.S. consumers are not borrowing. They're in fear mode. They're saving, as I said. That's a deflationary process. We're seeing the velocity of money, which gets a little bit esoteric, but it just means money that's being created by the government isn't getting to the real economy. And we're also seeing private deleveraging in a very big way still around the globe because of the outstanding bad debt or bad paper out there in many institutions, publicly and privately. So that deleveraging is countering what the government's doing. We saw this in Japan. Japan's debt to GDP ratio rose from 70 to 170%. They went for zero interest rates for 6 years, and they've gotten into a massive deflationary environment. So it's not always about money in and of itself. It's about how does money get into the real economy. If you can lower rates as much as you want, but if nobody lends and nobody borrows, money doesn't provide stimulus for prices in the real economy.
And as far as the real economy goes, and we only got a couple of minutes here, but this is important because real people with real money, Jack, have decided in large numbers, in some cases, as individuals, to get out of the game, to park that cash. And it's just too scary, it's too weird. How do you get those people back into the game?
You have to attack the real economy, meaning you have to have incentives for the entrepreneur to really get back in the game. If the private capital doesn't make it down to the entrepreneur, and it isn't because we see about 2.5 million small businesses have collapsed over the last couple of years, the money isn't getting into, as I said, to the real economy. It has to be there. There has to be incentives on that side of the fence because that's the only way it can rejuvenate an economy, create jobs, and create optimism. You're not going to do that from top down, saving morbid banks. So it's a matter of tax cutting, it's a matter of cutting regulations and all those things, and we're doing just the opposite in the U.S. Piling on taxes, piling on more regulation, and we're saving morbid companies and instead of letting the dead wood come out, and that's creating fear across the board.
Okay, but sorry, but we're limited for time, and I want to get you on regulation because a lot of people look and say the primary reason for this gong show that resulted in the crash and the recession was a scary, an unbelievable lack of regulation. It was a Wild West show, Jack. And so now they're looking at what they see as a lack of regulations, trillions of dollars in stimulus spending and bailouts going out the door, and not a corresponding choking up on the reins in the marketplace. I gather you would disagree with that.
Well, there's two types of regulation. There's regulation on real business, which comes in labor regulations, pollution standards, and all types of things like that.
Okay.
And then there's a lack of regulation in the financial sector because of the hand and glove actions of the government and the banks. There were tons of regulatory authorities in here, but they all got fat, dumb, and happy on really free credit and kept the game going. So that's a separate issue from the real economy. But if you look at the regulation defined by the Federal Registry in the U.S., number of pages in the Federal Registry, it's become massive again on small business, and that's what creates jobs in America, not the big institutions.
Sure.
The reason Reagan was so successful in the early '80s and created rejuvenation, he cut the Federal Registry by 50%, 50% regulation of small business, booming economy, booming jobs, and I think that's the way the U.S. has to recover. But we're going the wrong way.
Okay, so more loosening of the reins in the general marketplace, but how do you satisfy at the same time those who see a lack of regulations as the root cause of a lot of our troubles today on the other side of that fence?
No doubt there was, especially on the derivative side of the fence, allowing the investment banks to create these products and pull in massive fees and create systemic risk across the board. There's no doubt there was little or no regulation in that area, and it gets into that whole too big to fail problem. I think if the government would have let a lot of these dinosaurs fail, these assets that they've wasted on their books would have gotten into the real economy, meaning let some of these dinosaurs fail. There are plenty super regional banks in the U.S. that could have stepped up and taken those place, and that's what the market does. The bad ones are supposed to fall all the way, and those that are getting stronger would have come up. So I think it was a policy standpoint, it was a major mistake trying to save them. You know, it kind of the barn door was, you know, it was open, and you know, whatever that phrase is.
Right.
But
they closed the barn door long after the horse had left.
That's exactly right. Yeah, that's exactly right. But no doubt they blew it on the regulatory side there.
Jack Crooks from Black Swan Capital. A pleasure to meet you, sir, and I very much enjoyed this. I hope we have the opportunity to do it again.
Thank you, Sterling. My pleasure.
Comments made on House Street Video and HouseStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HouseStreet.com. House Street Video is a production of House Street Media Incorporated.